Let's move on now and talk about mergers and acquisitions. This is actually a long reading. There's a lot of what I term preamble stuff. That is, we have some soft issues to deal with, terminology, those types of things, sort of conceptual analysis. And then eventually we're going to get into some more number crunching type stuff. We'll see some discounted cash flow, some relative valuation things, and then we'll finish off at the end with some information on about evaluating a merger bid. So we're going to talk about mergers and acquisitions in general terms, what it means, different financing options, the types of mergers, that type of stuff. Then we'll dive into valuing the merger target. That's where we'll see the discounted cash flow, relative valuation, and then we'll have some sort of outro stuff where we talk about a merger bid and a little bit about the aftermath and market results for merger acquisitions and how that impacts targets and acquirers. So let's dive in. So the forms of integration. So what we're doing is we're taking two companies and we're putting them together, right? So this is standard M&A stuff. I think the terminology here is, well, the terminology is very clear within the curriculum. I think that some of this bleeds together in actual practice. But terminology, as is stated in the curriculum, is really important because that's the language that is used to ask the questions on the exam. So you want to make sure that you have the terminology down and you can separate out the different types of mergers and those types of things. So first of all, talking about the acquisition, this is where one company buys only a part of another company. So you got company A. They're going to be the acquirer or the bidder. They're going to give something of value to company B, and they're going to take in a division or something along those lines. So you can see the animation. So it would be a company that buys the suitcase division of some conglomerate somewhere. That would be an acquisition. If we wanted to talk about a merger, this is where one company absorbs another company entirely. So we have company A, they're going to be the acquirer, the bidder, sometimes referred to as the parent, okay? And then company B is going to be the target. Well, company B is going to be completely subsumed into company A. So we're just going to have one company when it's all over, and company B ceases to exist, at least as an independent entity. A statutory merger. So a statutory merger, this is where the acquiring company obtains all of the target's assets and liabilities, and the target company is going to cease to exist. So you'll see, I think the animation here is actually pretty clever. You see the assets and liabilities from company B go over to company A. But what about this equity part right here for company B? Well, if you're thinking back to your financial statement analysis stuff, remember that we don't consider the equity of the target company, right? So it's going to drop away. So it's going to be the assets and liabilities get moved over to company A, and company B, the target, is going to cease to exist, and those equity accounts just go out into the void, I guess, right? So we end up with the one company, and of course this is where we end up with all that, all the goodwill and minority interest stuff and all those types of things that can come about in terms of the acquisition. Well, I guess in this example, not minority interest. But anyway. Okay, so what about a subsidiary merger? Well, in a subsidiary merger, the target company becomes a subsidiary of the acquirer. So it's still going to exist and it's still going to produce its own financial statements, those types of things, but it's going to, we're going to see that it's subsumed, and the accounting treatment is a lot like what we were just talking about. But we are going to have what was an independent company is now going to be a subsidiary of what is usually a larger company, right? So, and it's frequently a good thing. It's the American dream, right? Start your company, sell it to a bigger company, or take it public. That's how you cash out and get you an island in the Bahamas. Consolidation. So the acquirer and the target both cease to exist at a consolidation merger, and they form a completely new entity. So we have company A, company B. They decide to hole up together, and they essentially both go away. And what we end up with in the end is this new entity that is going to be in this graphic, company C. So, and you'll see, and to some extent, of course, in the United States, the accounting for almost all of this is the same now, but it's the way it is billed in the financial press. So this is, company A, company B, they come together and they will take on a name that is some sort of amalgamation of the names of the two prior entities. So anyway, consolidation, we have a completely new company that's formed at that point in time. Now, I think that what we've talked about up to this point is based in accounting and maybe some in marketing. That is how we present the idea of combining entities. But here, we're still talking about types of mergers, but now we're thinking along economic lines. So you can think of the horizontal merger is a merger between two entities that do something similar, right? So in this case, we have the example is a small clothing retailer and a medium-sized clothing retailer. Well, they can merge, right? They can become a single entity. And when you put a small company together and a medium company together, you usually get a medium company. But in this graphic, it's a large company. You have to put lots of medium-sized companies together to get a large company usually. But anyway, the point is, what we're doing is taking one clothing store, another clothing store or chain, whatever it happens to be, and we're putting that together. So horizontal means same business, right? As opposed to the idea of vertical, which applies to an acquisition or merger up and down the supply chain. So you can think of your entity, whatever it is that you're looking at as being home base. You can have your suppliers above you. You have your customers below you. So in this case, if we have a computer manufacturer and an electronics retailer, well, the computer manufacturer is part of the supply chain for the economics retailer and vice versa. It's all in the same supply chain. But a vertical merger is where we're integrating along the supply chain. So it's when a car company buys a tire company or a steel company or something along those lines. So anyway, so when we put those together, we're going to have, we're integrating along the supply chain, and there's frequent talk of synergies associated with this. It seems like these have become, well, there have been more of these, at least in my experience, that go sour than in any other type. Trying to integrate along the supply lines have been difficult in corporate America over the last 40 years. Okay, so what about conglomerate mergers? Well, conglomerate mergers, that's not horizontal or vertical. That's where we're going to take two unrelated entities and we're just going to cram them together. So the example here is a shoe manufacturer and an organic food store or organic food restaurant, and we put those together, and there we have a new entity that is now a combination organic food and shoe retailer. No synergies between them. And you see a lot of conglomerate-type mergers if you look back through time. We'll get back to the idea of conglomerate mergers later, but as some foreshadowing, this is, at least in financial theory, this is not a good idea. So this conglomerate merger takes these two entities which investors could invest in separately. I could get exposure to the shoe company, or I could get exposure to organic foods. But once you put them together, okay, then you're going to end up with, if you want shoes, you got to take organic food with it. So it limits the options available in the market. And typically, these sell at lower multiples than non-conglomerate type firms. So what we see is financial markets go through waves, and when financing's cheap, we buy everything, and we put all these companies together, and then at some point in the future we start breaking them up through the LBO process, and I guess that keeps the investment bankers investment bankers' garages full of Ferraris. So anyway, so conglomerate mergers typically are not going to trade at as high a multiple just because of specialization of management teams and those types of things. All right, merger motivations. Now, one thing to keep in mind here is that when we talk about merger motivations, there are the motivations that show up in the press release, and there are other motivations that we all know exist but nobody wants to talk about because they are less than noble in some sense, or either that or they would attract the unwanted attention of regulators. So the big all-time granddaddy merger motivation, if you read the press release, is synergies, right? So this is the big one. And the idea here is that the whole is worth more than the sum of the parts. So we're going to have two entities. They're worth $10 each, but when we put them together, they're going to be worth $25, right? Why is that? Because of savings on logistics, or complementary customer bases or cross-selling between the customers of the two companies. Maybe it's advertising synergy, that type of thing. So economies of scale, economies of scope are going to either boost revenues or cut costs in some sense, and this is going to be a true value-add merger. And so synergies is the one that everybody's looking for, and it seems like every merger that gets announced talks about it. The actual evolution of synergies, well, I guess it's like a lot of things in life. There's a lot more talk of synergies than there actually is synergy that occurs. But anyway, that's not to say it never happens. What about the other merger motivations? Okay, achieving more rapid growth. This isn't. There's nothing particularly sinister about this. We're going to talk about life cycle influences in a little while. So what you're going to see is you're going to have companies at the end of the life cycle that are slower growth, and they're going to want to buy higher growth entities, right? So there's reasons that doesn't work on many occasions, but nonetheless, there's nothing sinister about it, provided there would be some sort of logical reason that this older company would buy some sort of younger company. So we're going to have increased revenue growth, and the notion is maybe that it is less risky to acquire an entity that is already, has a product out there, is growing very quickly, than it would be to go out and develop your own product in that same market space. So so the idea is the older company has cash and low growth, the younger company needs cash and they have high growth. When you put them together, maybe that makes a good marriage. Okay, what about increased market power? Okay, well, this is one that you're definitely not going to see in the press release, right? Increased market power, well, that's going to be influence over prices, okay? And, the FTC in the United States is not going to be happy if you're saying, look, if we buy these other two companies, well, then we can gouge the consumers because we're going to have such a dominant position in this particular market space. Well, there may be that's the reason you're doing it, okay? But you very rarely are going to see that in the press release, because it's like saying, ooh, come disallow my merger, federal government, that type of thing. So anyway, it may be a reason, but it's certainly not one that we want to talk about. Gaining access to unique capabilities. So there are superior management teams. There's people that have really well-developed, well-honed our research and development programs, those types of things. So there are reasons to go in and buy a company because you want access to a particular aspect. So, the unique capabilities are as varied as capabilities are, so meaning that there would be examples in all sorts of different areas. Kraft Food was acquired because their management team was particularly able to squeeze profitability out of an asset base. So they wanted the acquirer in that case wanted access to that particular management team. So anyway, unique capabilities would be one. Diversification, this is one that I would pay attention to. So when we talk about diversification in terms of maybe it's most evident in conglomerate mergers. So we're going to take these unrelated entities and put them together. Well, are we able to achieve diversification? That is, are we going to diversify away the noise in cash flows, changes in cash flows, those types of things. So if you think of this as, we're looking at over time against cash flow, well, either entity independently, could be something like this, right? But once we put them together, to the extent that they're not perfectly correlated, just like with two equity issues that we put together in a portfolio, we're going to see that we can smooth out the bumps in the variability of the cash flows or earnings or anything else we wanted to measure. So it is true that when we take these entities, particularly if they're unrelated, they're shoes and organic foods, when we put them together, we're very likely to see a smoother earnings stream out of the combined company. Well, the problem is that did we really want to put these two things together and smooth out the earnings? We already had access to the two companies, and when you say, well, I'm a shoe guy, okay, so I want to be able to, I know a lot about making and selling shoes. Well, that's great, but do you know a whole lot about organic foods? So typically there's going to be some sort of management issues associated with this. So it's unlikely to increase value, even though it stabilizes cash flows. So diversification, you do see people talk about this. When you do, lots of people shake their head because we don't necessarily want diversification just by taking two unrelated entities and putting them together. Okay, bootstrapping, I would pay special attention to this. We're going to talk about it in just a few minutes in a little more detail. But basically, this is the idea of an accretive merger. So if you want to talk to CEOs about what companies they buy, then they can give you a big long list of things they're looking for and things that make mergers work and how they bring their expertise to bear and all that sort of stuff. Okay, but in the end, okay, what we see is that these are high PE firms and they buy low PE firms, and what they see is there's going to be a positive impact on their earnings per share. So EPS is going to go up, it's accretive, and they like it when their EPS goes up. Now, do they create any value in doing that? That's a whole other story, and we're going to get to that in a little more detail in just a few minutes. So, anyway, we'll come back around to bootstrapping of the merger motivations. Bootstrapping is the one that's going to get the most attention in the curriculum, right? So these others are just sort of, well, know the name, all that sort of stuff, but we do need to talk a little more depth about bootstrapping. So what about personal benefits for the managers? Well, of course, that could be a big motivation behind lots of mergers, but you'll never see that one in the press release. It's like, I'm going to squander a bunch of shareholder money, but I'm going to have a bigger company and have a higher probability of getting my picture on the cover of Forbes or whatever magazine you read. Anyway, so the compensation goes up for top executives as companies get larger. So, you know, the personal benefits to the manager could be significant. Okay, tax benefits. So if you have a target that has accumulated losses, so they've got tax loss carryforwards, you got another firm that's paying lots of taxes, well, when you put them together, you may be able to access those tax losses to your benefit. If that's the only reason you're doing it, the regulators are going to disallow it. So tax benefits are not usually talked about in the merger announcement. They're going to talk about the fundamental values they create and all that sort of stuff because they want their tax benefits and they don't want the regulators to come in and change the reason they're interested in acquiring the firm to begin with. So anyway, so tax benefits would be one. Unlocking hidden value. Okay, well, I suppose that shows up in in press releases from time to time, and I have no idea what it is. So anyway, I mean, I think I know what they're talking about, or at least what they're hinting at, but and it's the idea that if we apply new management expertise or bring in new capital, they're going to be able to unleash some sort of economic juggernaut out of this target. But I don't know. It's like we think there's synergies, but we don't exactly know where they're coming from is the way I interpret that. Right? Okay, so achieving international business goals. Okay, so I think this has become something that actually occurs with I guess, greater frequency and probably with the good reason in many cases. So there can be market efficiencies that you want to exploit. So we want to be able to produce in some country with cheap labor, those types of things. I think this idea of avoiding disadvantageous government policies is a big reason. And it's not just tariffs, although tariffs could play a role in that, but also in some countries to produce there you need a local partner for multiple reasons beyond just the idea of tariffs as you bring product into that country. So there's technological issues. Either we're acquiring something that's very technologically advanced or leading edge, or we have technology that we can bring to bear in that marketplace, and that would be something that we could exploit by taking our technology, applying it in a new market, and that would create value in that way. So we can also do product differentiation. We have we're supporting existing businesses or existing customer relationships that we have in these other countries. So internationally, I think this makes some sense depending on the company's growth strategy and those types of things. All right. Let's go back now and talk about bootstrapping for just a moment. So here's the idea. What we're looking at here is we have a high PE firm and we have a low PE firm. Now, we'll come back to this idea, but remember, there's a reason a high PE firm has a high PE and a low PE firm has a low PE, right? So if we're talking about $1 worth of earnings, So, each firm earned $1. Well, in one case, we're willing to pay $15 for that firm, so we're paying a multiple of 15 times earnings. In another case, we're only paying 10 times earnings. Well, there's multiple reasons for that discrepancy, but the biggest driver of differences in PEs is going to be the forecasted growth between the two companies. So high PE firms are high growth and low PE firms are typically low growth. And of course, I'm ignoring a host of other factors, not the least of which is risk, right? So, but let's think of that as being primarily growth induced for the moment. So if we look at this high PE firm and they want to acquire a low PE firm, well, we let them print their own currency, right? So here I'm a high PE firm. I want to buy this other firm. They have a lower PE. Well, if we do a stock deal, okay, then I just print up stock certificates, right? I'm printing my own currency to buy this lower PE firm. So the idea is, okay, I'm going to buy the earnings of this low PE firm, and I'm going to subject them to my high PE ratio. So if I could buy this company at 10 times earnings, bring it into my stable, and then the market give me a multiple of 15, well, I'm going to be increasing or creating market value of 5 times the earnings of the low PE company. Make sense? So if we could bring the earnings of the low PE firm in and subject them to the high PE multiple, well, that would undoubtedly be creating value in the marketplace. The question is, does that happen? Okay? And while it is the case that EPS is going to increase, okay, we may see that the share price or the PE ratio of the combined firms is not going to be equal to the PE ratio of the high PE firm before the merger. All right? So let's think of it in those terms. So in other words, there's no real economic gains here, right? Unless if there were synergies or tax benefits or if we could unlock some hidden value somewhere, well then there could be some real economic gains. But if we're just talking about buying a low PE firm, we're going to hold up together on the same balance sheet and same income statement. Okay, there's no economic gains there, and the market is going to very rarely be fooled by this sort of basically accounting entries, right? So as a quick example, we have Weaver Inc. here is planning to acquire Knitters Inc. So in the dynamic yarn industry, I guess, weavers and knitters. So the financial data is going to show up on the next page, okay, and we're going to think about Weaver's post-merger earnings per share, and then determine whether there's been any real economic gains or economic value that has been created here. All right? So, and this data is the entire story here, so we'll have to go through this a little more carefully. But here's the basic idea. So you see that we have Weaver's here has a share price of 60, earnings per share of $4, so they're trading at a PE multiple of 15. Right? Well, okay, so the market is willing to pay them 15 times earnings to own a share of this company. On the other hand, Knitters, they have an earnings per share of $3, and they're trading at a share price of 30, so their PE ratio is 10. Right? Well, if we could take this $3 and we could subject it to that PE multiple, wouldn't that be great, right? So that would say Knitters would actually be worth $45 a share rather than $30. So if we could buy Knitters for $30 or something close to it, and then the market tell us, oh, now that you have owned those earnings, they're worth $45 per share, well, that would be a great outcome. No doubt about that. The trouble is, are we going to create any real synergies here? And the answer in this example is, well, it's sort of assumed in our numbers, but is no. And so how does that happen? Okay, well, if let's assume that the market capitalization of Knitters is $1.5 million. So we're going to have to buy Knitters for $1.5 million, and we're going to ignore takeover premiums and all that sort of stuff here. But that means that we got to issue 25,000 new shares of Weaver stock. So Weaver's going to print up 25,000 stock certificates, not literally, but we don't do that anymore, I don't think. But anyway, print up some stock certificates, and we're going to give those stock certificates to the current owners of Knitters stock. So it's a stock deal. It's an acquisition of stock deal. And so 25,000 shares, our stock's worth $60 a share. That means that's the $1.5 million in value. So we're going to start out with the shares of Weaver of 100,000. We're going to issue 25,000 more. Knitters stock is going away, right? So this company is not going to exist anymore. We're bringing them into the parent company. So ex post, okay, after the merger, we're going to have 125,000 shares of Weaver stock outstanding, and Weaver will now be Weaver and Knitters combined. Everybody all right with that? Okay, what about earnings? Well, the earnings were $400,000 for Weavers. They were $150,000 for Knitters. And that gave us earnings for the combined entity if there are no synergies of $550,000. So we still have $550,000 in earnings for this firm, but what's happening to our EPS? Okay, well, now we've got $550,000 in earnings, right? So we're just adding together. We're assuming there's no synergies here. We're ignoring a lot of things about, asset write-ups and depreciation changes and all that fun stuff from the financial reporting and analysis section, but let's just keep it clean and simple. Right, so we've got $550,000 in earnings, and we have 125,000 shares outstanding. And the point here is that we have now an earnings per share of $4.40. Right? So that's just going to be 550,000 divided by 125,000. So earnings per share have gone from $4. Okay, this doesn't exist anymore. Right? So $4 to $4.40. Okay, but what about market capitalization? Well, and the point of this is, if we assume that the market is not fooled, right, and the market capitalization of the combined firm is $7.5 million, well, if you take $7.5 million and divide it by 125,000 shares, you're going to see that the share price of Weavers is still $60 a share. Okay, and that's going to give us the main result here, which is this PE ratio of 3.64. Well, what is the point? Okay, the point is, okay, we took high growth assets that were worth a multiple of 15, and we combined them with low growth assets that had a multiple of 10. But when we put high growth assets and low growth assets together, then what we overall get overall is average growth, right? High plus low is equal to average, okay? And high PE plus low PE is equal to average PE. The point being that even though EPS has gone up, the PE ratio has gone down, okay, and there was no economic value created because of this merger. So any, and that's a big statement, although it's probably close to true. So any high PE firm can buy any low PE firm. And in the short run, anyway, if they're not going to destroy the earnings of the low PE firm because they do stupid things, they're going to have a higher EPS. So bootstrapping does increase EPS. High PE firms buy low PE firms in a stock deal. Okay, we see that EPS goes up, and there would be some accounting things that we could talk about that, if the difference between the PE ratios was small enough, we could nullify. But typically, this is what's going to happen in the vast majority of the cases. So we see an increase in EPS. But if we're not creating any real economic value, okay, then that's just going to lead to the PE ratio being lower after the entities combine. All right? So the point is that there is no real economic value created there. Okay, let's talk for a minute about industry life cycle. So the joke I tell is that CFAI has never met a life cycle they didn't like. They show up in a number of places across all the levels of the curriculum, and they show up as either 4 or 5 stage life cycles. So what we see here is a 5-stage life cycle. So the pioneer development phase, then the rapid growth phase, mature growth, stabilization phase, and then decline phase. If we wanted to do a 4-stage life cycle, we would take stages 3 and 4 and combine them into a mature phase or something like that. So you'll see it presented both ways. And it just depends on how you want to break out the point where the curve starts to slow down, but we still have the possibility of above average growth. So pioneer phase, this is going to be for companies that don't have a consumer acceptance of their products. They're pioneers, right? They're developing something new. We don't know if they're going to make it. They're going to have really high capital infusion rates or cash burn rates, as we sometimes refer to it. So these are going to be the firms that we're wondering about, are they going to be able to actually gain some traction in the marketplace? Rapid growth firms, these are the firms that, okay, the market has decided this is a great thing. Competition hasn't yet entered the market, at least not in a big way. Interestingly enough, what we see in rapid growth firms is that they have, of course, rapidly growing sales. and they have falling price, okay, but increasing margins because they're in such a sweet spot on the economies of scale. So they're going to be, prices of their goods are going to be falling, but their production costs are going to be falling even more rapidly in many cases. So this is a really fun time in the life of a company. Mature growth, that's where, all right, we are expanding into the corners of the market space, if you want to think of it that way. Growth is overall still faster than the growth rate in the economy, so firms in a mature growth phase can grow faster than the overall economy, but it's certainly the case that the growth party is over. And if you were working for a rapid growth firm and they were doing things like, hey, every Friday we're going to bring in lunch for everybody, suddenly there's going to be memos about how, well, we're not going to do Friday lunch anymore, and instead we're going to have a picnic once a year, and those types of things. So the mature growth phase is less fun. Stabilization phase, this of course is the big behemoth company that growing at something like the average growth rate in the economy. So if you want to grow at an above average rate in a stabilization phase firm, then you've got to basically take market share from someone else, and then you've got the decline phase at the end, and this is where product life cycle and company life cycle don't converge perfectly, but you can think of these products are getting older and fewer people are using them. So I don't know what that would be. I was trying to think of something with my cell phone that seems to change so rapidly, but maybe landlines, right? So landline, if you're making landline phones, that was what your business was, well, you're definitely in the decline phase. And if you want a way to think about this, if you have a friend that's starting a business and you just don't know if they're going to make it, and they keep moving into smaller apartments or sleeping on your couch, well, then they're in the pioneer stage. If all of a sudden they buy their own house and things seem to be going really well, they're in the rapid growth phase. As they transition from rapid growth to mature growth, this is where they buy a Ferrari. Stabilization phase, that's the company you work, and decline phase, that's the company where your parents worked. So anyway, you can think of it when you look at your friends and parents. Now, as a life cycle, like I said, it shows up in lots of different places in the curriculum, but let's take a look at it and contrast it with this idea of mergers. So what sort of mergers do we see occur where in the life cycle? So first of all, talking about this pioneer development phase, well, remember, low product acceptance, low profit margins, negative profit margins perhaps, and large capital requirements for these firms. They're trying to build a better mousetrap, and so lots of R&D, that type of stuff. So the merger motivations here, well, they need access to capital. They also may be in need of managerial talent, the people that can conceive and develop the product and bring it to beta. All that sort of stuff are not necessarily the ones to take this and monetize it in the marketplace. And the types of mergers we see here, okay, well, we'll see horizontal mergers. So you've got people in the same technology space, for instance, and they say, well, we're both struggling, but you have X, I have Y. Maybe if we come together, we'll have a better shot at surviving in the market. Also, the idea of conglomerate mergers. Well, what's happening here? Well, you've got the decline firm at the end of the life cycle. You've got the pioneer firm at the beginning of the life cycle. These guys are dying. Their growth is negative. These are high growth potential firms. Okay? And so we're going to go in and we're going to buy this little firm, infuse the capital that's required. Hopefully it's going to be a home run, and that's going to revive our dying firm so we can keep our jobs. So anyway, so you'll see conglomerates decline stage, or maybe even something in the mature growth or stable growth stage come in and buy these very young firms on a regular basis. So what about rapid growth? Well, again, we're still going to need access to capital because we're going to expand our production facilities. So that's going to be a big need for the firms in this rapid growth. These firms, though, have high profit margins, growing sales and earnings, and still fairly low competition. That's why they're rapid growth. What are we going to see here? Well, exactly the same types of mergers, conglomerate mergers, where in this case, the acquiring firm is getting in later in the game after the concept is well proven, so they're going to pay a hefty price for it. So I actually serve on the investment committee for a little firm that's in play at the moment, and I can't believe what people are talking about this little company being worth. I wish I owned about 20 times more of it than I do. Anyway, so, but nonetheless, the horizontal merger as well. So you get two very high growth products, and someone says, well, you've been East Coast, we've been West Coast, we can be nationwide if we get together. So that's for rapid growth companies and mergers, you'll see conglomerate and horizontal. What about mature growth? Well, remember, this is where our profit margins are going to start to fall. That's the economic model. Competition comes in. Competition means more supply. More supply means falling prices. Falling prices means lower margins. So we're going to have these lower margins due to new competition. But we still have an overall above average growth in this particular market. So there's still the possibility to have a growth. You don't have to steal market share to grow at an above average rate in a mature growth phase firm. But what we're really going to be focused on is efficiency, right? So these are the ones, like I said, that are going to stop buying everybody lunch on Friday, or, bonuses are going to be smaller, or whatever it happens to be, because the party is definitely coming to an end. And the types of mergers, here we're going to see horizontal mergers, and you may see some firms here start to try to vertically integrate. So we're big enough, we're established, we have good credit relationships, all that sort of stuff. Maybe we're going to go and buy key suppliers or key distributors, those types of things. Stabilization phase. Okay, so here competition has driven the industry returns down to sort of the economic norm, right? So what the shareholders are earning is just enough to keep the capital employed in the industry. And because we can read the writing on the wall, the order of the day is efficiency, right? So if we think there's economies of scale available, so if we could be 3 times as big as we are now, then we go out and buy 4 or 5 companies, and we grow in size because we need to make sure that our fixed assets are squirting out as much product as they possibly can. So cost efficiency is going to be a big deal, and that may inspire these horizontal mergers, right? So we got to be bigger because we've got to get the absolute maximum utilization out of our production facilities. So you go buy other products, related products, and produce them in your facilities. And then finally, the decline phase, of course, is where you have falling margins. You've got too much capacity. You're going to see some casualties here in terms of industry exit, that type of stuff. And these firms are interested in survival. Okay, they're typically, so these are sometimes referred to as cash cows, and we don't need to invest because we have excess capacity. So whatever cash we are generating, okay, we can do something with it. What do you want to do with it? Well, how about we go and we do these conglomerate type mergers where we're buying something early in the life cycle in order to buy growth. Maybe we'll see some vertical integration trying to achieve every possible economy along the supply chain. And we could even see horizontal mergers here as they say, look, I'm dying, you're dying, maybe together we can survive a little bit longer, sort of the Sears and Kmart type thing. So anyway, so the decline phase. Now, what is it that you need to know from all this? Well, I can tell you a story about all these, about each of these phases and the types of mergers and all that type of stuff. But you're going to be answering questions coming at you really quickly on the exam. So I think there's an easier way to conceptualize, or at least to sort of, I guess, contain this information for exam purposes. And if you go back and look, what you'll see is that horizontal mergers occur in all the life cycle stages, right? So that's always an option. You buy someone who does the same thing. There's, complementary technology, customer base, that sort of stuff. So you'll see the horizontal mergers across the life cycle. You typically see vertical mergers in the mature growth stage. So that's where the firms are, saying, well, we've got a lot of cash. We don't have a lot of positive NPV investments. So what do we want to do? Let's buy our suppliers, buy our distributors, those types of things. And the conglomerate mergers are at the ends of the life cycle. So at the beginning of the life cycle, you got the high growth, need cash. At the end of the life cycle, you got the low growth, but lots of cash and need growth people. So they end up, getting together in terms of these conglomerate mergers. So I think this is a more intellectually efficient way to categorize this for answering questions on the exam. So anyway, life cycle and merger, like I say, the curriculum loves life cycles, so I would be able to think through the life cycle issues vis-a-vis the merger stuff. It's just too easy to write questions on that. Okay, what about form of acquisition? So several things here, and this really we could have done this back when we were talking about statutory or whatever mergers earlier. But we could do this a couple of ways. We can either have a stock purchase, so that's where the target company's shareholders sell their shares directly to the acquiring firm. Right? So if I want to buy this company, well, I'll just go in and I'll tell the shareholders, hey, I will pay you $60 a share for your stock, and then they send in the stock and you send them checks for $60. Okay, the other way to do that is an asset purchase. So here the acquirer makes the payment to the target company to acquire the assets. Okay, and who receives the payment, okay, is going to have some tax implications and approval implications and those types of things we'll see in just a moment. Okay, in terms of payment method down here, we can do a security offering. Most frequently, that manifests itself as a stock deal, right? So we're going to have some sort of exchange. We'll give you 1.4 shares of our stock for every 1 share of your stock. And the exchange ratio, remember, the number of shares outstanding is basically an accounting function. So how many shares are you going to authorize, all that sort of stuff. So you can see this be 1.4 to 1. You could also see it be 0.4 to 1. And it doesn't imply that it doesn't say anything about the premium. You have to look at how much is actually paid in order to understand that. And then also a cash deal. Okay, that's where the acquiring company is just going to take cash and write you a check. And as target shareholders, you don't own a company anymore. Okay, but you do have a big pile of cash, and that can be fun under some circumstances, right? Kind of hard to think of the circumstances under which that wouldn't be fun, now that I said it. Okay, so what is the form of acquisition what difference does that make in terms of, the ins and outs of the merger? Well, of course, who receives the payment? Okay, well, is the payment, the actual check, is that going to the target firm? Well, if I write a check to the firm, that means I'm buying just the assets. If I write a check to the stockholders, then I'm actually buying the stock. And one of the big determinants of how I'm going to do that is going to be the liabilities. Because if I buy the stock, right, I'm buying this entity, I'm buying the whole thing, then typically the acquirer is going to assume the liabilities of the company. And that would imply financial liabilities, of course, but also other unbooked liabilities. And just because you acquire assets doesn't necessarily mean you're going to get out of this, but what about environmental remediation issues and some sort of product liability issues and those types of things? Well, if you're doing an asset purchase, you might be able to avoid some of that. The courts are, there's lots of money at stake, and you never know what the courts are going to do. But the idea is, with an asset purchase, you can avoid assuming liabilities. So, if we are buying the company by writing checks directly to the shareholders, well, it's the shareholders themselves that have to decide whether to sell the shares, right? So who's going to pay the taxes? Well, if you have a share of stock, you paid $60 for it. I come in and offer you $85. Well, then you're going to have to pay the capital gains tax. Okay. On the other hand, if I'm doing an asset purchase, okay, then I can go in and write a check to the target firm. It's the target firm that is then going to be selling assets, probably at a premium over book value. So it's the target firm that will be responsible for the capital gains taxes in that particular case. All right? So anyway, so the choice of stock purchase versus asset purchase, there's some grounding in reality or economics there in terms of, well, what about assuming liabilities and unbooked liabilities, but also in terms of who is responsible for the taxes, who is actually going to approve the deal. Is it going to be, the board of directors, or is it going to be the individual shareholders, that type of thing? So there's some ins and outs there that you probably want to be on top of. Okay, let's talk about the attitude of target management. So that is the managers of the target firm. Well, two kinds of environments. One would be a friendly merger. So I'm the acquirer, so I call you up and say, hey, I'm interested in buying your firm. Would you like to have lunch? And you say, well, for the right price, I'm interested in selling. Yeah, let's have lunch. You buy. So anyway, so we'll have some negotiations. We'll go through the whole due diligence process. Okay, we'll have a definitive merger agreement, have all the lawyers and all the analysts involved, and then we'll have a public announcement. So a friendly acquisition, friendly merger, we can do all of the pre-merger stuff essentially behind closed doors, and if we could control leakage, which is very difficult, but if we could control leakage, it could be a surprise. So they could announce that on Friday afternoon, and everybody go, wow, I didn't see that coming, right? So that would be with a friendly merger. But what if you call the target management as the acquirer, and you say, hey, I'm interested in buying your firm. Would you like to have lunch? And instead, they make some sort of rude gesture involving middle fingers or something like that. Well, then that means that we're going to be in a hostile environment, right? So a hostile takeover. And hostile takeovers, quite honestly, are becoming I guess, a thing of the past, just because, well, there's some legal issues associated with it that we're not in the curriculum, so I won't go into them. But hostile mergers are not nearly as common as they used to be. So the acquirer is going to submit a proposal to the target's board of directors, and if it's successful, well, that's what we were doing over here, right? So we submit a proposal, well, then we're back into the friendly environment. But if the board of directors says, well, no, we're not doing that, okay, well, then if the acquirer still wants to proceed, they have two options. They can either do a tender offer, which says they're going to announce to the public, hey, we're willing to buy the shares of stock in this company for $60 a share. It's currently selling at $45. And, if you get enough shareholders to tender their shares, then you're going to own the company. We could also do a proxy battle, which says we're going to track down as many of the shareholders of the target firm as possible. We're going to send them a letter saying, hey, shareholders meeting's coming up. We would like to vote your shares, okay, on this one item. It could either be the merger, or more likely it would be on positions on the board. So we're effectively trying to get people to vote for our people to get them on the board of directors, so that we can get this board of directors to be friendly to us, so that we don't have to go to a tender offer and all that sort of stuff. So we're trying to take over the board, and once we take over the board, well, then we'll give everybody $60 a share and move forward. So hostile takeovers, those were very common at one point, less so now. And the reason they're less common now is because we have all these pre-offer defense mechanisms. And I'm someone who is not a fan of pre-offer defense mechanisms. I think it messes up the market for corporate control. It gives management it makes management entrenched, so that if they're not maximizing value, you can't get rid of them anyway, or it's at least much more expensive to do so. But nonetheless, there's also people who would argue on the other side of this. So the big granddaddy of pre-offer defense mechanisms is a poison pill. And this is actually, all firms either have a poison pill or they have one on the shelf they can get pretty easily. And that's why hostile mergers have become less and less common. But what a poison pill is it gives shareholders the right to purchase more shares at a discount. So think if you're trying to acquire the firm, you're out there buying up shares. Okay, and we say, well, anyone who owns less than 2% of the company, they can get new shares for $30 when currently the market value is $60 or whatever it is. So we're going to flood the market with more shares that we sell at a discount. That's going to make the acquirers, the portion of the firm they've already bought, look smaller. It's going to make it more expensive, all those types of things. So it's going to cause problems that most acquirers simply can't deal with, right? So there's a flip-in pill where the target shareholders can buy shares in the target company at a discount. Also a flip-over pill where it says, and these are challenged in court, of course, but if the acquisition goes through, then the target shareholders can buy the acquirer's share at a discount, right? So a poison put, this is where the bondholders can demand immediate payment in the case of a takeover. So you've got all these liabilities outstanding, and not that most acquirers are worried about liabilities and financing. They're usually in better shape than that, but it does up the ante in the sense that we've got X billion dollars of bonds outstanding, and as soon as the merger goes through, the bondholders effectively can demand payment at that point in time. Well, that's going to increase the problems and the cash required to actually take over the firm. We can also incorporate in a state with restrictive takeover laws. So, Ohio is a state of choice for this. So if you want to say, well, where is it that I can charter my corporation that's going to give me the best anti-takeover provisions? Well, Ohio would be one of those. And I'm guessing that the citizens of Ohio reap the benefits of having lots of firms that pay corporation fees there. Okay, what other pre-offer defense mechanisms? There's lots of these. I think there's one more slide after this. We could have a staggered board. Remember we talked about a hostile takeover? Well, take over the board, you've taken over the firm effectively. So what if we did like the Federal Reserve Board of Governors, and that's intended to isolate it from external entities, but what if we structured our corporate board the same way? That is, you're elected to the board, you serve for 14 years, there's 7 members of the board of directors, and they serve in staggered terms. So every 2 years, one board slot comes up for vote. Well, if you want to take over the board, then you can get a slot this year, right? And then 2 years later you get one more, and 2 years later you get one more, and 2 years later you can get that fourth board seat that will actually give you a majority on the board. But it's going to take all those years to get to it. So if you have staggered boards, that means it's just harder to take over the board of directors, and that's going to make it harder to take over the firm. So restricted voting rights, this is as far away from capitalism as I can imagine it being. But anyway, so this is where equity ownership above some threshold level causes the loss of voting rights unless approved by the board. So that's like saying to me, well, if you buy the whole house, you don't get to live there, right? So if you buy part of the house, you'll be okay, but if you buy the whole house, you don't get to live there. So anyway, I obviously have some strong opinions on that. But all right, so supermajority voting provisions. This is less sinister in my mind, so it's a major change and requires, corporate charter issues, all that type of thing. But it just says, look, there are certain issues that require more than a 50% vote. So 75 would be a number that said, well, if you can get 75%, then you can take over the firm. Okay, but you can't do it with merely 50%. Okay, also fair price amendments. This is where the corporate charter requires that if you want to take over the firm, you have to pay us a fair price. The fair price here, they say, is based on an independent appraisal, but we get to choose the appraiser, right? So it's currently trading at 45 in the market. You offer us 60. I don't think that's fair. We're really worth 100, and I know because I hired this Holmes guy from BYU, and he gave us an appraisal of $100 a share because, my spreadsheet will accept any assumptions. Anyway, so if you need a really high appraisal and you're willing to pay a lot for it, then give me a call. All right, so what about golden parachutes? These are I don't know, they bug me, but nonetheless, they're not usually a big enough deal to mess up these big mergers. But this is where, if the firm is taken over, well, the reason target management would oppose a merger is because they lose their jobs, right? So, they're going to be out on the street and not able to make their mortgage payments and all that sort of stuff. So this is where the managers are going to receive a cash payout in the event of the company being taken over. So they'll receive some number of millions of dollars. Okay, that's pre-offer. So all those last three slides were pre-offer defense. So those are things you put in place just to keep people from sniffing around. But if they do sniff around and actually decide to make an offer, there's also post-offer defense mechanisms. Okay, we can do the just say no. So, no, we're not going to take that, go away, get out of here, and just refuse to talk, provide data, all that type of stuff. We could go to the courts, and that is, all right, you want to take us over? Well, we're going to sue you. It doesn't matter what we sue you for. We're just going to bring in a team of lawyers. We're going to consume all your time, your money, and just make it as difficult as possible. Green mail. So a firm can repurchase its own shares. This is sometimes referred to as a targeted repurchase. That is, we have this stock, it's selling for $45 a share. Someone has accumulated an 8% stake at $45 a share, and they're out there talking to people about taking over the firm, and they're telling people that me, as the manager, I'm not doing a good job, and I really hate that. What I'd like for them to do is go away. So they've been buying these shares at $45. I go to them, I say, look, I'll buy your shares back. Just yours. This is a targeted repurchase. I'm not doing this for everybody. I'm just doing it for you because I like you so much, that we're going to buy your shares back at $65 a share or something. So you make a lot. The potential the potential acquirer makes a lot of money. You can think of this as blackmail. So we're just blackmailing this acquirer to go away because we don't want anyone saying we're not doing a good job. And there are special tax. If you are ever the recipient of green mail, then you will have some special tax liabilities associated with that. So anyway, we're just paying off the acquirer to go away in this case. Okay, a share repurchase. Well, we could just do a non-targeted share repurchase. We just start buying up our own stock. So there's less out there. That means that if you're buying it, you're getting it from all the little shareholders. The big block shareholders out there, they're your friends anyway. So you've been courting them, taking them to lunch. So maybe that's one way to consolidate your power. A leveraged recapitalization. So my stock's selling for $45. Someone comes in and offers $65 a share. Well, there's no going back after that, but what you could do is you could go out and borrow lots and lots of money, and you could, say, okay, you're going to keep their stock. I'm going to give you $35 today, plus I'm going to give you a coupon that you can bring back for $10 next year, and you'll still own the company or something like that, right? So we're going to borrow money, pay out huge dividends, maybe some other structural changes in the way we finance, and we're going to say, look, all this is worth more than that measly $65 that other guy offered you. The crown jewel defense, this just says, look, the reason they're buying this company is because we have this one really great thing that they want. So let's take that one really great thing and sell it to somebody else. Okay? So we take that major asset and we sell it to a third party who's not going to try to take over the firm and not going to fire us and all that type of stuff. The Pac-Man defense, that is, you want to acquire me? Well, like heck, I'm going to acquire you. So you launch a takeover bid for the firm that was rude enough to come and say that you're not doing a good job and try to acquire you. So a while back we had, Joseph Bank tried to acquire Men's Warehouse, and Men's Warehouse turned around and said, well, we're going to acquire you. And I think it was actually Men's Warehouse that won, but I don't remember what came out of it. Anyway, so White Knight defense. So White Knight says, well, you know, you were really rude in the way you said all those bad things about us in public. So we realize that we're not going to be able to stay, we can't go back to the pre-offer world. So what we're going to do is we're going to find a friendly third party and sell the firm to them. Right? Because they've promised us that we can keep our jobs, we'll still have time on the jet, all that sort of stuff. So that's a White Knight defense. We also have a White Squire defense, which is where we don't sell the company to someone else, but we sell a big enough stake. We sell 35% to someone so that now the acquirer could almost never get enough, get a majority of what is still outstanding so that they could take over the firm. So White Knight versus White Squire. So post-offer defense mechanisms. Okay, a few other things here. So, well, I guess a lot of other things before we get through this reading. Herfindahl-Hirschman Index. Okay, I grew up calling this the Herfindahl. I don't know if we'd offended Professor Hirschman or what. Anyway, this is a measure of industry concentration, and it's going to impact what's going on with the merger, or whether a merger will be allowed. So there's a couple of ways to measure concentration in industry. And of course, what we want is we want a competitive environment. So industries that are highly concentrated, well, we don't want, if there's only 3 players in the industry, we don't want 2 of them to merge, right? Because that's going to be anti-competitive. So how do we calculate or think about industry concentration? Well, one way to do that would be to do what's called a 4-firm index. RM, I know how to spell firm. And that's where we take the market share of the market share of each of the 4 largest firms in the industry, and we add them together. So if we got someone with 10, someone with 5, someone with 5, and someone with 3, well, we add it all together, and that's 23%. So take the biggest 4 firms, add their market share together. Well, that's great, except for what if we have a 4 by 25 industry, and we have a 1 by 100 industry, right? So 4 by 25 says there's 4 equal size competitors. Well, you add it all up, that gives you the 4-firm concentration ratio is going to be 100. And if you have a monopoly, 1 firm, well, you got 100 plus 0 plus 0 plus 0, that's also 100. The point is, with a 4-firm concentration ratio, you can't distinguish between different industry structures at the high end of the concentration, right? So these would look exactly the same. The 4-firm concentration ratio for a 4 by 25 versus a 1 by 100 would be the same be the same for both of those industries. Well, that's why we use the Herfindahl. So the Herfindahl takes the market share of all firms in the industry, and sometimes you'll see this as the largest 50 firms. But anyway, call it all firms. You're certainly not going to be dealing with anything more than 50 on the test. And you're going to say, well, let's take that. We're going to take their market share. We're going to square it, and then we're going to add it all together, right? So if we had, firms that the largest firm in the industry had 1%, we'd take 1 and we'd square it and get 1. And we'd do that for all the firms, and then we'd add them all together. So if you're looking over here for these two industries, right, a 4 by 25 versus a 1 by 100, well, 4 by 25, so you take 25 squared, that's 625, multiplied by 4, I think you get 2,500 over here. And 100, well, 100 squared is 10,000, so you'd get a Herfindahl of 10,000 here. Well, the point is, now these 2 industries look different, right? We have a measure that is able to sort of disentangle the impacts of high concentration versus ultimate concentration. So at the high end of the concentration ratios, the Herfindahl does a better job. And it's just a matter of taking the market share and then squaring it and then adding them together for all of the firms in the industry. And why is it important? Well, this table describes why it's important, and that is when we look at the post-merger Herfindahl, okay, you can think of this in terms of whether or not a merger is going to receive opposition, okay, from the regulators. Well, if you have a post-merger Herfindahl of 1,000, So, okay, we had 20 firms. 2 of them decide to hole up together, so now we only have 19. But after they go from 20 to 19, we calculate the industry's Herfindahl. It's still less than 1,000. Okay, well, that's a competitive industry, so it's not concentrated, and we're not likely to see any antitrust action there. If the post-merger Herfindahl is between 1,000 and 1,800, well, that's what we call moderate. And if you have moderate concentration, well, we might have a couple of medium-sized firms that are going to merge, and that wouldn't bother us too much. So then we're going to look at the change in the Herfindahl. We're going to say, well, if the post is between 1,000 and 1,800, and the change, that is pre minus post, post minus pre, sorry, is 100 or less, then maybe we'll get some regulatory intervention, but it's certainly not certain, and maybe even unlikely, depending on what the state of the economy is and how busy the regulators are. If it's greater than 1,800, then this is a high concentration industry. That is, there are few players here, and if there are few players, that doesn't mean you can't ever have a merger. You might have a big firm that buys some little bitty firm, just like squash them like an ant. So if the pre to post change is less than 50, then you won't have a problem. If it's more than 50, then it's almost certain that you're going to get some sort of regulatory involvement in the United States. And the reason I add in the United States is because while these numbers on this side may seem arbitrary, less than 1,000, 1,000, 1,800, and greater than 1,800, this is promulgated by the FTC. So the FTC said this is how we're going to view industry concentration, and we are not going to allow anti-competitive mergers. Right? So if you're going to be really concentrating in industry, all else equal, we think competition is good, and we want more competition, and we're going to move through the courts to block mergers that would say, well, the post-merger Herfindahl is greater than 1,800, and you had too big an increase from pre to post. So this is how to interpret industry concentration via the Herfindahl index.